The Cayman Islands Chamber of Commerce Pension Plan, we're here for you. The Chamber Pension Plan is asking for all members to ensure their member details and contact information is correct and up to date. To review and update member details, simply visit chamberpension.ky. Log into your account and provide the necessary information for your personal profile and for your beneficiaries. For assistance in updating member details, call us at 745-7630 or email admin@pensions.ky. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. I'm Simon Caudry and I'm delighted to be joined in the studio this morning by Ben Freeman, CEO of Proven Bank. Ben, good morning.
Good morning, Simon. How are you doing?
I'm very well and thank you for joining us at this early hour. Ben, you're joining us this morning as we explore the topic of interest rates and what it means for borrowers and potentially for savers as well, but what it means most importantly perhaps for borrowers who have seen massive rises, potentially massive rises in interest costs against their mortgage, against their car loan and other things. But I introduced you as the CEO of Proven Bank, and that might be an organisation that lacks some familiarity to a number of our listeners. So perhaps just give us a brief info on who or what Proven is so that we have some context to our conversation.
Okay, great. Well, again, good morning. Thanks for having me. So Proven Bank is what people will know as the old Fidelity Bank. So Fidelity Bank was owned by Fidelity Bahamas. It was a subsidiary. And in February, Proven group of companies that's based in Jamaica. They're made up of a capital business, a private equity business, and a wealth business primarily. And they also had a bank in St. Lucia branded Boslow Bank that will now be called Proven Bank St. Lucia going forward starting February 1st. And so they're very interested in building a banking business, and the business was available for sale. And so they purchased it in February of this year. And so Proven Bank is very similar to the old Fidelity Bank. I mean, they...
It's the same locations, same places.
Well, so we're going to have the retail stores at Dr. Roy's, and we're going to be refitting the Fidelity Financial Center to house our corporate and private banking team. And we'll also house our wealth sister company, that's Proven Wealth, as well there once we do the refit. That should be done sometime this summer. And the rest of the business is still at Dr. Roy's. And we focus on, savings accounts, checking accounts, term deposits, residential mortgages is a big focus of ours. We give auto loans, personal loans. So if you think of us like a savings and loan bank with highly personalized service. So we're going to be focused on making sure that when people come into the bank, they can talk to a person. And when they have issues, they can talk to a person at the bank. So that's going to continue to be our strategy.
And indeed, one of the issues perhaps a lot of people have come into the bank over the last 12 months or so to talk about is this concept of rising interest rates, which we've highlighted on this show in 2022 about the threat of rising interest rates. We talked about the need to raise interest rates because of inflation. We all know how painful inflation is in the Cayman Islands right now.
Yes.
And we now are seeing the consequences of that with rising interest rates. So just talk to us a little bit about what's happened in Cayman and why, and perhaps why Cayman sees its interest rates rise, because we don't have a central bank like other countries do, which causes rising interest rates. So why is Cayman affected by the actions of other central banks? What's the reason for that?
Yeah, so historically, if, for example, in the U.S., the market's dominated by what we call fixed-term loans or fixed-rate loans, which is typically between 15 and 30 years long. But in the Cayman market, the customers, they prefer variable rate loans, which is tied to some sort of an index across the world. In Cayman, it's tied to the prime rate in the United States. And the reason banks they are happy to give variable rate loans is because cost of funds rise and fall depending on how interest rates and markets change. So when you're funding your balance sheet and interest rates rise, you're going to have to pay depositors more money to put the deposits. You use those deposits to pay loans. So it allows banks to manage that spread between cost of funds and the deployment of funds when you give mortgages. So that's why banks offer that product, and usually customers accept it because you can offer it a lower interest rate. Because if you don't know the future, nobody knows the future. And so let's say you were a bank, and back 3 years ago you gave a mortgage when rates were 3%. And you gave a 30-year mortgage. Well, now depositors are coming in, they're saying, wait, interest rates are higher. I want to borrow at 5%. I want to loan you, deposit money with you at 5%. Well, the bank will lose money. So there's more risk associated with fixed term rates. So you generally charge a higher rate at the time you give the mortgage. So variable rates are usually a little bit lower at the beginning, but if interest rates rise, then you could be on the wrong side of that equation. And that's what's happening a lot in Cayman right now, because variable rates are the preferred offer for customers. Even when interest rates were rising, we began to offer fixed-term rates 3 to 5 years to customers, and only a select few really chose that option. They still wanted to sort of roll the dice on how interest rates were going to develop.
And I wanted to ask about that, because it's not just people who are on variable rates who are seeing the shock of higher interest rates now. I mean, obviously they are. But not a lot of people, but some people may have been persuaded 3 to 4 or 5 years ago to say, let's lock in what's a really attractive rate. Let's lock in this 5-year fixed rate at 4% or something like that. And now that 5-year period of time has expired, and they're suddenly seeing that really attractive rate. Well, it was attractive, but now they're seeing that refinancing shock and that sticker of, hey, it's no longer 4 or 5, it might be 8 or 9. So those are meaningful changes for a lot of people, aren't they?
They are. They're very meaningful. And I think that when you do get a mortgage, you do borrow money as a person, you need to really think about those things. You need to think, well, what will interest rates be in 5 years? And even though I can make the payment over the next 5 years, what happens if the interest rates rise? Banks also do the same thing. We look and we say, okay, what happens in 5 years if interest rates rise, let's say 300 basis points? So if we stress test all our loans, we say, can the person pay the loan at, let's say, 3% interest, and can they pay it at 6% interest? But in this rising environment, it's actually gone above our actual stress tests at the time certain people would have gotten their loans. So yes, it's difficult. You need to really budget yourself and be disciplined when you borrow money, because these things do happen. And if your rate goes from 4% and then it balloons to prime plus 1, let's say, now instead of 4%, you're paying 8.5%. So your mortgage is going to double, and it's going to be very stressful for you unless you prepared your budget accordingly.
And it's often not just, that's not the only thing that's doubled or gone up substantially. So on the one hand, your mortgage might have gone up. On the other hand, your car loan might have gone up. And then you're also seeing, as you go to Foster's or Kirk's or one of the other supermarkets, you're also seeing your actual cost of living in other areas go up. So suddenly your whole budget has been affected by this exactly the same phenomena.
That's correct.
So what are some of the options that people have? What should they do when they find themselves in these circumstances? What are their options?
So I think one of the good news stories in Cayman is that housing prices have risen. So we've been looking at the value of our portfolio of loans, and we just did some revaluations of properties. And most properties in the last 5 years or so have gone up in value of 50% up to 100%. So let's say you have an auto loan or you have a personal loan, and you want to consolidate, and you're getting, if you loan money and you don't have security against that, it's going to be a higher interest rate. So let's say you get an unsecured personal loan, you might have to pay 12% for that, because if the bank doesn't have an asset to claim back. If you get an auto loan, there's an asset there, and the bank will charge you a little bit less because there's a value of the asset. And then houses are the same. So that's usually the cheapest way to borrow money. So let's say you own a home and you have an auto loan, a personal loan. You can consolidate your debt. Go to the bank, and if you have equity in the home because the value has risen, you might be able to use some of that equity to get a lower interest rate. So basically, take the car loan, that's a 10% loan. Personal loan, that's 12%. Credit card loan, that's 16%, because many people have multiple debt points. And then you consolidate it under a loan for the home. While maybe with a variable rate it might be still 8%, it's still much lower than you have on these others. So you can consolidate your debt is one option. I'd say the other option is go to your bank. If you really look at your budget and you say, look, I'm really stressed here because of inflation, because of higher interest rates, go to your bank, engage them in an open, honest conversation about your situation, and try to work out with them. Maybe they can extend some of the length of your mortgage or your loans, or maybe they can restructure it to its more affordable payments. So I think it's always best to be transparent with the lending institution rather than wait until you can't pay, and then you're coming there, because it's, trust between the bank and the customer is very important. And so the bank will really trust that, okay, this is a responsible person. They're coming to us saying they're in this situation. Maybe they didn't get the bonus they expected. Maybe they lost employment. We're seeing a lot of that as well. And then so the bank will then engage you in a conversation and see what can be done.
You talked just about a minute or so ago there about the benefit of rising house prices, and certainly Cayman's seen a housing boom that seems to have lasted for 25 years perhaps. There may have been one or two small dips, but it's gone up substantially. So I just want to dwell on that a little bit more, because someone who, say, bought a house 5 years ago and got a 75% loan to value mortgage perhaps, suddenly interest rates are now, or their cost of servicing that debt has now doubled potentially. Yes. But equally, their loan compared to the value of the house may have started at 70%, and you're saying may now only be at 50%.
That's correct.
So what they could do is they could say, well, borrow more. You could potentially borrow some more money or extend the term. Right. So you can use that equation in order to reduce your monthly outgoings, thereby allowing you to be able to buy those things that are the essentials, to feed your family, to put petrol in the car, to do those sort of things. That's the nuance that you're talking about there.
That's correct. Yeah. So you could call it a home equity loan in the U.S. We call it an equity release loan, and so you loan money, let's say at 80%, sometimes 90% loan to value. In other words, you borrow $100, and if you put down 10, that's called 90% loan to value. If you put down $20, that's 80%. And so, like you're saying, if you have value 50%, you could go to the bank and say, I want that 30%, and if we can refinance the mortgage, so yes, you can use that for bills, etc., to cover this time. Because look, inflation's rising, but by all forecasts, it's starting to moderate. And I think, the Federal Reserve, the reason they've raised rates is really to slow the economic output. So therefore, inflation will the demand side of the equation, which has been very high, will sort of catch up with the supply side, which has been impacted by global conditions. So that should hopefully moderate inflation over the next 12 to 24 months. But I think it's going to take some time. But if you can get over that hump and inflation starts getting down to 2-3%, it would be, which is a historical target the Fed looks at, then you'll be in a better position. Now, that being said, you always have to look at your budget, because, look, if you go, in a sense, borrow more money, in the long run, your payments and the interest you're going to be paying over, that period of time is going to rise as well. So there's, in a way, no such thing as a free lunch when it comes to that. But it can alleviate the pain.
Yeah, you're saying, look, the next 2 years for a lot of people may well be very painful. Yeah. Inflation may well come down, but it will take a bit of time. In the same way it took the Fed a while to react to inflation, put interest rates up, it may take them a while to react to falling inflation or declining levels of inflation and push interest rates down. But you could use these sort of home equity loans or lines of credit to help yourself have spending money during those periods of time when interest rates are high, so that then when they go down, you can then start to use the savings you've got from interest rates having risen or having fallen, to actually pay off some of the debt that you've accumulated during these more difficult times.
Absolutely. That's exactly what I'm saying. It's just, when it comes to debt, you need to sit down, and sometimes it helps just to sit with a financial planner, like Proven Wealth has financial planning and other companies here, and sit down and run through the mathematics with them and say, and come up with a plan. And that's always helpful to know what your plan is. And it de-stresses you understanding that. If you're just in the dark on something, it's very stressful. But finance is about numbers, and it's about really looking at what your projected income's going to be, and where you currently are with your finances and what your assets are. The good news too in Cayman, I think, is that I think the market's going to continue to rise. Maybe not as fast a rate as recently, but
you're talking housing prices.
Housing prices, yeah, because the demographics in Cayman are very good. There's a lot of people moving on islands. We're talking to law firms, accountancy firms, relocation firms all the time in our business, and I think the demographics indicate that the housing demand is still going to be high. I think even though there's a lot of construction going on, it's still going to be high. The flip side of that is that it's hard for people to afford it, because people are coming on island, and it's housing prices go up. It's hard to get that first home and come up with that 20% deposit to put on the home. But,
because 15 years ago, a single family home might have been $150,000. That now might well be $300,000, exactly the same property. Exactly. So you're thinking 15 years ago, I had to find $15,000, $20,000. not impossible, not easy, but not impossible.
Yes.
Now I've got to find 40 or 50. Well, that could be a whole year's salary for a lot of people,
Yes.
which is much more difficult to find, and that's part of the challenge, isn't it?
It is. The market has been very hard for especially people in the lower income categories. And I think, unfortunately, that's the flip side of rising housing prices. For some people may help if they can take equity out, but it's going to make it more challenging for people buying, particularly the first home and entering the market. So we've been talking actually with the government about what we can do to help on the low-income side, what sort of opportunities we can provide people with in terms of getting that first home, waiving some fees and making sure we set aside some funding for lower-income people entering the market, because I think that's really important for the country.
I think that's we'll actually rejoin that conversation straight after the break that we just need to take. So join us again in about 60 seconds, I think, for our continued conversation with Ben Freeman of Proven Bank.
The Cayman Islands Chamber of Commerce Pension Plan, we're here for you. The Chamber Pension Plan is asking for all members to ensure their member details and contact information is correct and up to date. To review and update member details, simply visit chamberpension.ky. Log into your account and provide the necessary information for your personal profile and for your beneficiaries. For assistance in updating member details, call us at 745-7630 or email admin@pensions.ky. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Welcome back to Money Sense. Today we are joined by Ben Freeman, who is the CEO of Proven Bank, and we are discussing banking, mortgages, interest rates, and all of those things that, frankly, for a lot of people are quite scary right now because of the fact that interest rates have gone up. Just before the break, you mentioned that you're in conversations, you and I suppose the banking industry are in conversations with government about trying to explore ways of making things more affordable. Yes. Maybe that's not the right phraseology, but certainly there's a dichotomy in Cayman, isn't there, between people who are wealthy,
Yes.
who are really not struggling in this higher interest rate, a higher inflation rate environment, because they already had savings, and the fact that the milk is now, I don't know, it might be $20 by the end of the show, the rate the price of a pint of milk goes up in the supermarket. But that doesn't make a huge difference. But for a lot of people on lower middle income, it's really, really difficult to actually go to the supermarket because every time you go there, however small a basket, it's $100, it's
Yes.
$120.
Sure.
So what sort of avenues are being explored to try and mitigate that for low middle income? Often young Caymanians who are trying to get into the workforce, trying to get onto the property ladder, trying to make their way in life.
Yeah, so I think the banks are, at least our bank, we're looking at putting together a program that would be just specific for people looking for that first home, let's say getting a mortgage of $150,000, $200,000, and looking at the terms that can make it easier for them. So, for example, having a fixed rate over a longer period of time, let's say a 5 to 7 year period of time, or expanding the term to 30, 35 years. So really focused on bringing the payment down to an affordable level, but also creating a program where, like you said earlier, about balloon payments, where after 4 years, they're not going to be kicked out of the house because all of a sudden the payment goes up to a level that they can't sustain. So I think it really takes a concerted effort from the banking community to put some money aside for those folks. We also can do things in banking like waive an arrangement fee. So we've charged 1% because it's a cost associated with getting all the mortgage documentation together, opening the accounts. We can waive those fees, for example, make it easier for people so that when they're putting their closing costs together, that helps them as well. I think the other banks are also looking at those types of options for people, because we recognize the fact that you can't just have a market that is for people who are high net worth, private banking, wealthy people that we know are coming on on the island. You need to have those solutions for the people who are living, working here, and are really stressed by this inflation and rising interest rate environment. One good news is I think, yes, there will be a period of time for a few years where interest rates will be high, but I do think there will be relief in the long run. We won't have, I believe, long-term 8%, 9% interest rates. I think that eventually they'll be more normalized down. I don't think we'll get to where it's 3%, but I think we'll be more normalized around maybe 6 or 7% in 2 or 3 years. But 2 and 3 years is a long time, and we need to find some solutions to help people.
And I guess that's why it's so important if one is struggling to have that conversation we're talking about, because there are, and we expanded on a couple, just this home equity line or extending the term during these difficult times to make the payments more affordable. Yeah. Because I think probably the most scary thing that a lot of people can imagine is defaulting on their mortgage payments and then finding their home repossessed. And it's been 25 years since we've had interest rates at these sorts of levels. And when Hurricane Ivan happened in Cayman, when we had other economic problems, we had some home repossessions, and it caused a lot of political concerns. It caused a lot of public policy concerns. But it could happen again, couldn't it? If people aren't honest and sensible, just open about their problems.
Yes, it can happen again. I mean, we have a few instances in our bank right now, and we try again. We try to reach the people, work with the people. Foreclosures for a financial institution, people may not believe this. We don't want to foreclose on properties. It's sort of the last last ditch effort for us in order to try to collect funds. But we are there to protect as well depositors, because it's not our money; it's depositors' money that we're deploying and managing that risk. So we'd like to do everything we can. But yes, in high inflation, high interest rate, if people lose their employment, like I said, there could be some disruption, and it's something we'd like to avoid as much as possible.
You mentioned that you think that the demographics in Cayman are positive for house prices. Yeah. Is there any concern that with higher interest rates that the affordability of housing becomes a little bit too expensive, and that causes some pressure on house prices?
Yeah, so it goes both ways. So there's the demand in the market of people coming on that may be able to afford those rising prices. But yes, there is the interest rates. So it depends where in the market you are. If you're in the market, let's say a home of 750,000 CI and above, my view is that the people moving on island, I don't think they're going to be sensitive to interest rates. They're going to be doing cash purchases, or they're going to be able to fund those in different ways. And you don't have to always get a mortgage to fund the property. You can fund it through some collateral you have overseas or what have you. So they have multiple means of funding properties, including taking the higher interest rates and just paying it off. If you're local here, it's obviously, and you're in the lower end of the market, then it's going to be far more difficult for you to do that. So we'll have an impact, and we're keeping a close monitoring on the raising interest rates and what it means for our existing customers, and making sure that if they're stressed, they know to come to the bank and really talk to us, because it's about payments. So if you're paying $500 a month and you can afford it, if interest rates rise, let's say you have a 20-year mortgage, if we could extend it to 25, 30 years, we could keep that payment. Although it takes you longer to pay off the loan, at least during this period of time, you can get through it. And I think that, there are quite a number of options you can consider to help yourself out financially. So don't see the financial institution as the enemy of the raising interest rates. They just want to get us, go to them and engage them in a conversation.
It can be quite imposing walking into a bank, though, can't it, and saying, I've got a problem. It can be imposing saying that in any scenario, in any walk of life, going into talking to your friends, even just saying that to somebody. So, but it's important to do so, is what I'm hearing you say.
Absolutely, and I think that we have proven we're going to when you come in, we're going to engage you in a positive way, and that's what I love about Proven is that our model is to interact with people. You're not calling a contact center. You're not dealing with people making these decisions that are overseas. You're dealing with people on the ground here that can help you.
Great. Now, the conversation so far today has been perhaps a little anxiety-inducing for people at 7:30 in the morning as they contemplate the remainder of the week and wish that they hadn't perhaps woken up this morning with the news of expensive mortgages and such like. But it's not necessarily all bad news, because a lot of people, it's this time of year, is people are having their year-end reviews and perhaps bonuses for certain things. And I think I was saying this to you before the show started. I was out running with a friend last night, and he said, well, what happens if I get a bonus when interest rates, when my mortgage was costing me 3-4%, I'd obviously use a bonus, and I might go and buy something quite nice. I might go and buy a boat, or I might go and buy a car. But now with the costs, perhaps people are thinking more sensibly in that sense. They're thinking, what should I do? Should I pay off some debt? So what would your advice be to people who are saying they're getting their year-end bonus and they're seeing all this calamity of higher costs? What should they be doing with that money that they get?
Yeah, so I would say finances, we call personal finance for a reason. Everything is always personal to you. I mean, it's your money, and you need to manage your money and make those decisions. But right now, there is opportunities, because if let's say you get a $10,000 bonus, and you have, a mortgage of $100,000 over the next 10 years, let's say, and you can decide, okay, I'll pay $10,000 down on the mortgage. Well, if you're paying 8.5% interest, that's like a risk-free investment earning 8.5%. If you went to offset that mortgage cost of 8.5% in the market, and you want to get a risk-free investment that pays you money, that you're not reducing your payment, you would go get a U.S. Treasury. You might be able to get 3.5%, maybe up to 4%. That's considered a risk-free investment in the U.S. because the Treasuries are considered infallible, which that's a different conversation for another one.
Yes,
but
quite.
Historically, people have seen that as the risk-free rate. So that means if you went and bought U.S. Treasuries with the $10,000 and you're paying the bank 8.5%, you're really losing 4%. Yeah. And so my advice would be might be a good investment for you to pay down your mortgage, and it's like getting an 8% return on your investment. Now, again, like I said, it's personal. So you might want to go, okay, I got $10,000. I'll just keep paying the mortgage, and I'll go buy myself a boat or a car or what have you. Or you might say, look, I like risk, and I know of a great stock investment I want to do, and I can get more than 8.5% return. I might be able to get a 15% return, which would be able to get money to pay off the mortgage, plus you have some in your pocket. But personally, I'm more conservative, so I would take my bonus and I would pay down the mortgage. That's a decision I would make, because I think that getting an 8.5% risk-free return in the market's almost impossible.
Yeah, the long run expected return investing in equities is about 8%.
Yes, correct.
And there's a lot of volatility associated with that, as we saw last year, where a lot of people lost 20, 25, 30%.
Yes.
So if your expected return in equities is 8% and your actual cost of
Correct.
mortgage is 8%, paying that off is, as you say, it can be a no-brainer. And equally, if you've got credit card debt or car loan debt or personal debt unsecured,
absolutely,
it might be at 12, 13, 14%.
That's correct. Exactly. So again, you should sit back and you should look at all your debt situation, and then you should look in and make some decisions there. But like you said, I'm focused on the mortgages with the variable rate increases. But on the credit card side, if you're paying 16%, that's a no-brainer. You're not going to get a 16% return that's risk-free, because when you're paying off debt, it's risk-free, because the reason it's risk-free is that that payment goes away. You've actually put that savings in the bank. And just
to ask you about that, when you pay off the debt, then I guess there are two scenarios. You could pay it off and then have all the debt be paid off sooner, or you could actually just reduce your monthly bills by paying off the principal, like keeping the term the same. Yeah. So your actual weekly or monthly costs actually come down, which helps you afford the other things that have become more expensive.
No, exactly. So you could, I would pay down the principal myself. I would, if you're paying 8% on that principal, that's what I would do. Or if you have $10,000 in credit card debt, pay it down. I mean, years ago I gave my brother that advice. He had all these credit cards and he had some money in savings. I'm like, he's earning 2% in savings. He's paying, let's say 10% credit cards or what have you. And I'm like, what are you doing? Just pay it off. He said, well, what if something happens? What if there's an emergency? I said, yeah, you use your credit card, right? So, I mean, that is always available to you. So you really need to try to look at what debt you have, and I think that's a good way of actually getting an investment return for yourself.
If someone's coming to you right now, which might be a difficult time for people to think about buying a house because of the expensiveness, would you recommend they go on a variable or a fixed rate at the moment, given where we are in the market?
Yeah, so I'm more comfortable with fixed rates, and just making sure, even though you pay a little bit more, then you're certain in your budget. And we do fixed rates up to five years. And so you may pay 1%, 1.5% more at the time, but you at least know what you're paying over that period of time, and you can manage your budget. So I'm really a proponent of fixed rates. But again, it's all personal to the individual, and we've been offering this to our customers, and they've been still choosing the variable rate for the most part. So it's a little bit too tempting for people at that savings of 1 or 1.5%.
Yeah, it is. I think psychologically, people seem to sort of like to take the risk of things going, the expectation, the hope that things may go down and be better, and forget, there's a psychological point here, isn't there? People forget that the risk is two ways, and that things do also go up in cost terms. And that's it's strange to try and understand why human psychology is like that. There's a lot of Nobel Prize winning research that's gone into that, and people are still trying to understand it. Look, we are, as always, on Money Sense, full of questions and lacking in time. It's already 8 o'clock, and thank you very much, Ben, for joining us. It's been a wonderful conversation. Welcome back personally to you to Cayman, and welcome to Cayman for Proven Bank, and very much look forward to seeing your business expand, grow, and in the news more.
Thank you very much. Appreciate it.
Thank you. Well, look, before we leave the airways, a quick reminder that Money Sense is available for viewing on the CFA Society Cayman Islands webpage, on LinkedIn or on YouTube. Simply type Money Sense Cayman into YouTube and off you go. You'll see all the different shows. If you have any questions, comments, or wish to suggest show topics for us, send us an email to moneysense@candw.ky. With that, all that remains for me to say is thank you for joining us, and please do tune into Money Sense again in 2 weeks' time.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
The Cayman Islands Chamber of Commerce Pension Plan, we're here for you. The Chamber Pension Plan is asking for all members to ensure their member details and contact information is correct and up to date. To review and update member details, simply visit chamberpension.ky. Log into your account and provide the necessary information for your personal profile and for your beneficiaries. For assistance in updating member details, call us at 745-7630 or email admin@pensions.ky. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.